Hello, everyone, and thank you for joining us to our May 24th CattleFax Trends Plus webinar. We're happy to have you join us today. We'll start off with just thanking Elanco for sponsoring this webinar. We do have Dr. Faulkner from Elanco on with us, and he will be giving a little bit of talk at the end, so we're excited to hear what he has to say. And again, we give our thanks for them Elanco to sponsor this webinar for us. Just a little, order of the house here. We'll start off, we'll talk a little bit about corn and hay, then we'll talk a little bit about the cattle markets and supply and demand expectations, and then just touch on a cattle market outlook for the rest of the year. The topic that's on everyone's mind today is not only the prices that we've seen recently, but also what does this mean for expansion, and are we going to start to expand here in 2023? Then Holden Ramey will pick up on talk about the 2022 cow-calf survey results, and then we have Dr. Faulkner batten cleanup, and we're excited to hear what he has to say. My name is Troy Bockelman. I'm an analyst here at CattleFax. I cover quite a few things, everything from beef to cattle to grains to trade and the protein market. So we'll just go ahead and jump in it. The first thing we want to discuss is just how significant this change in the drought index has been. If we go back and look at November 1st of 2022, we were talking about 14.5% of the country that was not at least in a dry situation, let alone a drought. And oh, what a couple months here has some changes, because now we're looking at the May 9th, and you're talking about a 54%, almost 55% of the country is not in a major drought, minor drought, or even in a dry condition. If this was updated for last Thursday, it would be up at 58%. This is the first time since July of 2020 that over half of the country has not been in a drought. So moisture conditions have improved, and over the course of the last couple of weeks, we've seen some pretty significant rainfalls here in Denver, with my place getting 8 inches more rain than I got all of last year. And some of that rain is even coming into Nebraska, Kansas, Oklahoma, and Texas, with some more rain expected this weekend. So that drought, that switch from a La Nina to a neutral, following up into an El Nino weather pattern this fall, is starting to take shape. So we had the WASDE report that was released from the USDA on May 12th. And ultimately, what that said is that stocks to use for corn are changing. And you can see that here on this bottom. We went from a 10.3% in old crop corn to a 15.3% in new crop corn. When we're talking about 92 million planted acres and trendline yield of 181.5 bushels per acre, ultimately ending in total use up 755 million bushels compared to production up 1.535 billion bushels. So there's some room here. If we lose some acres, or even if we don't get trendline yield, because of that usage increase, especially on that feed and residual side, yes, I understand, hogs eat more $4 corn than they do $8 corn, same thing with cattle. But I understand that as production decreases, if we don't reach that trendline yield, there's room in the balance sheet to keep stocks to use above that 14% as we go forward. So ultimately, I like looking at these charts here because they really show that perspective of what we're looking at. Look at the stocks to use compared to a year ago. You spent a year and a half, almost 2 years, with stocks to use below 10%. Historically speaking, we haven't seen stocks to use that low since the 2012-2013 drought. Now, stocks to use at 15.3%, they're at the upper end of the range. So ultimately, what that means is instead of going from a big stocks to use to a tight stocks to use, we're going from a tight stocks to use to a big stocks to use. And prices are responding lower. If you're looking at Deef corn futures, they touched below $5 a bushel recently. So ultimately, what that means is there's still some risk to the corn market. We've talked about even if we see yield drop off a little bit, we can still keep stocks to use above 14%. If you look at an inflation-adjusted scatter plot and using 4.5% inflation for the fourth quarter of 2023, that ultimately suggests that a 14% stocks to use, these corn futures could average $5 a bushel in the fourth quarter. That's significantly less than where we've been the last couple years heading into the fourth quarter. If you're at a 15.5% stocks to use, say yield is right where it's at, maybe demand softens a little bit, you're essentially talking about risk lower of ultimately 50, 60 cents from where the market is today going into the fourth quarter. Overall, we would expect that downward bias in the market to take hold, but recognize we still haven't killed the corn crop, right? The old adage is you kill the corn crop twice before every harvest. We're just getting the crop into the ground. 81% of the crop is planted through last Sunday. Pollination is going to come up in July. Weather is going to play an important role. We could have a little bit of a rally here in the near term like we've had over the course of the last couple of days. That could sustain through June, but ultimately, with a 14% or better stocks to use, we're going to see some relief not only in corn futures, but corn basis as well. Then the other feedstock, looking at harvested acres and the all U.S. average all hay price. Coming out of last year, hay was in a really tight situation. 2022 was the smallest hay production since 1959. And it was on December 1st, we had the smallest hay stocks in the country since 1954. We don't come out of that really fast. It takes a little bit to build up those stocks again and to have that production. So we wouldn't forecast to see a significant drop in price. But if we come back and look and say, okay, with 1.1 million more acres of hay and just a slightly better yield than the last couple of years, you could see production increase 8% or 8.8 million tons. Pretty significant, but still historically small. Not a huge number, relatively speaking, on both acres and production, but you'll start to get some relief. If we're talking about expansion across the beef cow herd, you need cash and you need grass. And if you have both of those things, you can start to get some calves. So we're starting to see the tides turn. The weather patterns are switching. We're starting to develop a hay crop. We're starting to see corn prices come off. So what's those margins going to look like as we go forward? Well, as we've gone through this drought, as we've gone into the cycle high for beef cow inventory numbers in 2019, we had a lot more cattle than we did harvest capacity. And the leverage shifted all the way through the supply chain and favored the packer. Now look, we have beef cow inventory numbers below where we were in 2014. And we would expect going into 2024 that we are still going to liquidate that beef cow herd. Hold on with me there for a second. We'll talk about why that is. But overall, we have the smallest cow herd since 1962. We're setting up for the next expansion, but it's still a little ways away. So you carry that forward and you look at beef cow slaughter. Beef cow slaughter has been trending lower. It's sitting here about 11.5% below year-ago levels, or about 146,000 head. But it's still not enough to slow the liquidation. That would imply a culling rate of 13.4% here in 2022. And that's the highest culling rate since 1957. The reason beef cow slaughter is dropping lower and we're still liquidating beef cows is because last year's slaughter was so big. Then you look at the beef replacement heifers. We were expecting them to be down or start to tick up as we go into 2024, but they're back there to 2011 levels. We're not starting to see an expansion across the heifer side. So those yearlings that are out there today, they're not being turned into replacement heifers, they're being turned into beef. There's still too many heifers in the slaughter mix, and heading to the feed yard to really start to see that expansion take place. Now, you carry that forward and you look at commercial cow slaughter. I talked about commercial cow slaughter being down 11.5% year to date. We would expect commercial cow slaughter or beef cow slaughter to be down 750,000 head this year. And you might look at that and say, well, 750,000 head decrease from a year ago. Surely that's a stabilization, not a liquidation. But look at how big that number is. That's still a big number historically. We talked about the culling rate in the previous slide. It still is slowing the liquidation, but it's not quite stabilizing the beef cow herd. The 750,000 head decrease sounds like a big number, but that's comparing to a big number a year ago of record high commercial beef cow slaughter. We'll start to see that continue to trend lower as we go forward, but this expansion will likely take some time to develop, and it could start here in the fall calf crop where we start to hold back some of those heifer calves to turn them into cows. If we pull a heifer calf out of the system this fall, that's not turned into beef until 2026. The other headwinds we're facing, if we're talking about the formula to get calves, you need grass, you need cash, interest costs are a major factor this year. If you could just come back and look at the cow cost to a finished steer, and ultimately what this looks at, it's not the price of the cow, but it is the operating costs to carry that cow for 1 year. You have almost double the interest cost compared to a year ago, almost $60 a head. Look at your stocker operators. Their interest costs are over double what they were a year ago. And your feed yards also have seen a pretty significant increase. Well, ultimately, your total costs have doubled from a year ago when you're talking about going from a cow calf all the way to the feed yard sector. So there is some additional input costs that are going into producing that calf that need to be accounted for this year, because after a couple years of virtually free money, interest is really starting to take a toll on these markets. Then you carry that forward and say, okay, what about demand? If we're going to start to increase the beef cow herd and start to expand the inventory numbers, is the demand there to meet us? Yes, it is. You look at the 2023 bar, that little yellow bar, and you say, well, it's down from where it was a year ago. Yes, it's down from where it is a year ago, but relatively speaking, the beef demand low was back here in 1997 and 1998. And that's that index of 100. And demand is still strong compared to that. Since 1998, the retail price has gone up 4% a year. The wholesale price has gone up 4.3% a year. Fed cattle have gone up 3.6% a year, and inflation has gone up 2% a year. So what does that mean? That means that the retail or the food service chain, the retail chain, the wholesale chain, and fed cattle since 1998 have all increased at a rate faster than inflation. Now let's go into 2023 and 2022. If we're talking about inflation, we'll use an average number of 5% for 2023. And beef supplies down 4% in 2023. Well, we're only accounting for retail beef price up 1% this year. So calculated demand is appearing softer because the retail beef price is not even keeping up with the rate of inflation, let alone the tighter beef supplies. But let's think about the last couple of years. 2020 was COVID. 2021, we had the supply chain refilling where all those restaurants where they closed down, they all had to come back and buy beef to fill their freezers again. So they were pricing in the tighter supplies. The inflation has already occurred on the beef side, and now we're seeing a little softer calculated demand, but it doesn't necessarily mean that beef demand is poor. It is continuing to stay strong. Now, as we go forward, we're going to start to rebuild this beef cow herd. Continuing to focus on genetics and nutrition and quality is going to be important. Look at this chart. This is the wholesale beef demand by grade. relative to choice and select compared to the beef demand low in 1998. Choice beef demand has grown 60% since 1998. Well, select beef demand is relatively steady. It hasn't grown significantly since 1998. What does that tell you? If a cow-calf producer is looking to increase their beef cow herd, it means that genetics and grade and quality are going to be important. That as we go into the next expansion cycle, we need to focus on quality because the U.S. consumer has said we want higher quality cattle, higher quality beef, we want upper two-thirds choice, we want prime beef, and we're willing to pay for it. So that's important as we think about this rebuilding of the beef cow herd. What animals are we putting back into the system? So you carry that forward, just looking at the Fed steer price. We've had an incredible run in the Fed steer price so far this year. As the warmer and wetter weather in Nebraska and Colorado and into Iowa created muddy pen conditions at a time that we're heading into tight supplies, the market put in a new all-time high for a CattleFax U.S. average Fed steer price. And we would expect a higher but seasonal market pattern. Look at last year. It was just steady almost all the way through the year. You got into August and you started treading higher. What do we mean by higher but a seasonal market year? We would still expect to see a break in the cash market, and we could come back to the low 160s for a summer low and come back and retest the highs as we go into the fall. So we would have an average Fed steer price of 164 in 2023 with a range of 155 to 180, and we've already been at that 155. We don't think we're going to have to go back and retest that 155. So we're starting, you notice retail prices only go up 1%, but look at the increase in the Fed steer price. The leverage has shifted from the packer back to the feed yard. And that leverage is going to continue to trickle back down to the cow-calf producer so that they can start getting the cash that they can start to expand. When you look at a 800-pound steer price, we would have an average of about 205 for this year with a $39 increase compared to last year. You look at what the futures market is pricing in today. You have August out here at 234. So August is right out in this area here, and you are out there in November closer to the 240. That's very doable as we think about the feeder animal price going into the fall. And why do we think that's doable? Because if we come back and we start tying some of this together, and we're looking at the April 2024 on the top chart relative to the October feeder cattle chart on the top right. And what we would be looking at here is essentially saying if we're placing October feeders against April, and we're sitting up here today with April at 179, so we'll call it 180. Cost of gains are moving lower. We talked about corn on the very first couple slides. Cost of gains are moving lower. And we could have a cost of gain that's out here closer to $1.15 or $1.10 as we get into the fall. If we have corn, these futures move below $5. Well, April futures don't even have to go any higher. And you can see you have a break-even price at the feeder cattle side up there at 234. And that's not even a cattle feeder that's starting to bet on the come yet. He's buying a break-even at 234 with a 180 deferred futures and a 110 cost of gain. So there's the potential for the feeder cattle market to continue to push higher, especially if we see the deferred live cattle futures push higher. If we're a stocker operator or a backgrounder out there, this is not a market on the feeder cattle side that we want to get aggressively short in. Yes, we still need to manage risk. We still need to protect equity in the cattle, but we wouldn't want to take an extreme short position out there in the feeder cattle board, because if you look forward and you start looking at the calf prices, 196 average last year. We think they can average 245 this year. We've already been to the lower end of the range, down here at 210. I think we're at the upper end of the range here. But if we start looking at where we could come out into the fall, and we talked about bringing the cash back to the cow-calf producer to start to fuel the expansion, it would not be a surprise if we see calves in the spot market in October in the fall calf run trading not far off of the levels they're at today. You look at some of those seasonals, you still have that longer term shape, but the calf market is tight. And if you're coming back and just looking at some spreads, well, if you're talking about a 550 to 800 pound steer spread in the fall calf run, it's pretty easy to have that spread around $15. Well, if you're talking about a 235 800 pound steer price, and you only have a $15 spread between the 800 and the 550, well, you have strong support for a calf market at 250. So that starts to bring that leverage back down to the cow-calf producer sector, especially if you start to see the cattle feeder bet on the come. You could have a market out there on the calf side closer to that 255 to 260 and not even really have a break going into the fall. The leverage has shifted back to the cattle producer. Then you come back and you just start looking at the spot cash 800 pound to 550 steer spread relative to the underlying fed cattle market. As the market continues to push higher in the next 3 to 4 years, we're expecting this market, this spread to continue to widen out. Look at where you were in 2014 through 2015. Essentially 110 to $130 above the Fed steer price. Well, if we're talking about a 180 Fed price, and we're going to go forward, you can do the math. The calf market and the feeder market can push higher faster than the underlying fed cattle market as we go over the next couple years. That's why I said we don't want to be aggressively short. We want to continue to manage risk on the feeder side, but the market has the potential to push higher, especially as cost of gains move lower. Now, talking about utility cow prices, we're expecting this year to see a utility cow price about $20 higher than last year. You know, we're kind of right in the middle. We would expect more of a $75 to $115 range as we go forward. So there's still some potential as we get into the summer. Our tightest non-fed slaughter is expected to be out there in August, with non-fed slaughter 12% below a year ago. If we have a 90s price up there closer to 3 to 310, there's margin for the cow plants to have a supportive utility cow price because we still have demand pulling 90s through the system. Then you come back and just, what's our expectation for the cash cost, profit or loss for an average cow-calf producer? We're talking about roughly $100 a head more margin for the average cow-calf producer in 2023. If you're going to be a high return producer, you're essentially talking about a $300 bill. That's the expectation for that margin as we go into this year. So if we're talking about expansion, we're starting to get the grass and the cash is starting to flow back to that cow-calf producer, but it takes a little while to see that expansion take place. As we start to rebuild this cow herd, we want to focus on animal health, we want to focus on nutrition, and we want to focus on genetics. So that's what I have for you today. Oh, no, one more chart. Sorry about that. Then that relationship between the bred cow and fed cattle values. You go back all the way to 1980, you can see that there's a pretty strong correlation between the bred cow value and the fed steer price. So if you just do that simple math, and if you're looking at a per dollars per head basis, that fed steer price that we had at 164 would suggest this year your bred cow value should be around that $2,300 to $2,400 range. Now I'll pass this over to Holden.
All righty. Thank you, Troy, and good evening, everybody. Thank you all for taking time out of your busy schedules to be here for our webinar this evening. And I just want to reiterate Troy's thanks to Elanco for sponsoring our webinar. Like Troy said, my name's Holden Ramey. I'm an analyst here at CattleFax. I handle both our membership on the fed cattle side as well as our feeder cattle membership. So with that, let's go ahead and jump in. Like Troy said, I'll be covering the 2022 cow-calf survey results. We open up here with kind of an overview of the survey so that you all can get an idea of what our sample looked like, kind of the demographics of the sample, if you will. The average cow herd size ended up being right there at 371 head. Cash cow costs at $682 a head. That's up about $70 from 2021, and that $613 was a record then, and so the $682 in 2022 would be a new record. Important to note here that these cash cow costs do not include return to management or depreciation. So if you were to factor those things in, cash cow costs would obviously increase. Calf revenue there came in up $154 from 2021. Looking at the average prices, they were up about $23 at $183 a hundredweight. And like Troy was saying, with where we've been so far this year in 2023, I'd expect the 23 survey to show prices up at least another $20. Looking at average weaning weights, steers there at 559 and heifers at 521. That's actually down 4 pounds from the 21 survey. At least part of the reason for this, I'd say, is just the widespread drought that Troy also discussed that we saw across much of the country last year. That subsequently limited grazing opportunities and drove feed costs higher. So I suspect that was a lot of the decrease in the weaning weights that we saw last year. There on the bottom two lines, just kind of looking at producers' plans over the near term anyway. Pretty evenly split down the middle, with 42% of producers looking to expand their herd over the next 3 years, and 43% plan to be about the same size at least for the near term. Looking at the cow costs here, we know that cow costs can obviously vary from operation to operation, but they also vary regionally quite a bit as well. Not surprising after seeing that cow cost on the opening slide, that costs increase across every region. You know, feed, labor, interest, leases, all our costs seem to have increased over the course of last year. So starting there in the west, that turquoise color, they came up $52 a cow, and this is the lowest increase of any region on a year-over-year basis. Northern Plains there in the blue came up $67 a head. That corn belt on into the northeast, kind of that orange color, increased to $77 on a year-over-year basis, and that is the largest increase of any region. Then continuing there clockwise, get to the red there in the southeast, they came up $56 per head, and then you finish off there South Plains. They were up $70 a cow compared to 2021. Kind of looking at regions against one another, you see very similar patterns that we've seen in previous years. The North Plains there in the blue continues to be the highest region from a cow cost perspective, and then the Southeast and South Plains there continued to be one of the lowest cow cost regions compared to the others. As we walk through some of the survey results, you'll notice that we break some of the results, or at least producers, into 3 different categories to present results. These would be high return, average return, and then the least profitable group of producers. And what we find year after year is that the high return producers don't compromise on these things: animal health, nutrition, genetics, and marketing. And we find that those first three bullet points that are underlined have a significant impact on our reproductive success as well as fertility rates. So just wanted to make sure you all keep these things in mind as we walk through some of these survey results and think about how they might impact the results. So starting off here, looking at fertility based on calf crop percentages, basically the number of calves per cow exposed broken down by return. And you can see here that the high return producers find a way to be the most productive and efficient when it comes to fertility, with the calf crop there at about 92%. Looking at the difference between our high return group and the low return group, on a 3-year average difference, it's about 3% between those two groups. And if you go back to our average herd size of about 371 head, 4% works out to be about 15 more calves that the high return producers get over the low return. So that's 15 more calves they have to market, as well as potentially less placements that they would need to secure. Just a quick note there on the U.S. average there on the far right-hand side of the graph. Calf crop percentages continue to creep slowly up over time, currently kind of sitting there in that 88 to 90% range. Taking a step further here, looking at calving lengths sorted by returns, we find that a majority of all producers have a relatively tight calving window. Focusing there on the blue bars, be your high return producers, about 86% of that group of producers calve within the first 60 days. And then you kind of look at the average return group there in the orange, about 76% of those producers calve in that same 2-month window. So we find that there are definitely benefits associated with tighter calving windows. Some of those we'll go over in subsequent slides. We realize that a 45-day calving window isn't necessarily realistic for everyone, as there are challenges with a calving window that is that tight. But 60 days or less is certainly something that we can all strive for if it's, of course, if it's practical for your operation. And we realize that you don't want to make any big changes in any one year due to complications that may arise. But if calving window's a little longer out there, 75 to 90 plus days, shortening up that calving length is something that should definitely be considered. Now looking at some of the benefits of a tighter calving window, like I said, one of the first benefits that we see is that gives females more time to breed back, and this certainly shows up in that top chart with your weaned calf crop percentage by calving season. We see that those that calve in that 0 to 45 day window consistently wean off a higher percentage of their calves. You step out there a little further in calving season length, that 46 to 60 day window, they're weaning off about 1 to 2% fewer calves than the 0 to 45 day group. And then you get out there, calving lengths that are 61 days and on up, they're weaning about 2%, if not more, fewer calves than those in the 0 to 45 day group. Jumping on down there to that bottom chart, looking at weaning weights based on calving length, we see benefits here as well. That we see that the shorter the calving window, the heavier that calves tend to be at weaning time. Between the 0 to 45 day group and the 61 to 90 day group, it's about a 30-pound difference on average. And this is certainly significant as we continue to market calves on a per pound basis, and more pounds results in more dollars. And at the same time, we'd anticipate that those cattle that were born in that 0 to 45 day window are usually a more uniform calf crop, which would only ultimately improve their marketability as well. So bigger picture here, taking a step back, that the data does support that a tighter calving window does prove to be beneficial to operations in a number of different manners. Um, Looking at weaning weights sorted by return, here again we find that the high return producers find a way to wean off heavier calves. Doesn't matter whether it's steers or heifers. And this makes sense based off the previous few slides that we've been looking at. Focusing there on the gray bars, the high return producers have a steer heifer average of around 572 pounds, and then looking down there to the low return producers, they average right around 512 pounds at weaning weight, and that's a difference of about 60 pounds per 60 pounds. And then if you go back to our average calf price for 2022 at $183 a hundredweight, that's about $110 a head difference on sale prices that the high return producers are getting over the low return producers. Just looking at a line graph here of annual average steer weaning weights, you can see back there in the time window from 1980 to 1990, weaning weights were increasing pretty exponentially, increasing 52 pounds during that time period, which is on average about 5 pounds a year. The more recent time window from 1990 to 2021, weaning rate weights have still increased, but at a slower weight, only about a pound a year for 30 pounds during the whole period. And then, like I mentioned earlier, back on the summary slide, weights this year were down a little bit weights in 2022 were down a little bit compared to 21, down about 6 pounds. And again, that could be blamed on drought. Looking here more recently, weaning weights seem to be plateauing out here in this area, as I think that the environment is limiting our genetic potential to some degree. And if this is the case and weaning weights are capped, things like calf crop percentage, marketings, risk management, all of these things become that much more important. Basically, we'll have to sell more calves if we can't sell more pounds per calf, if you will. Going forward here, looking at various marketing strategies and some things to consider. Starting off by looking at this graph, which looks at weaning length and calf values. Again, the height of the bars measured against that vertical axis. Measure the percent of respondents that said that that was the weaning protocol that they used. The calf values on the top of the bars are standalone values. We look at this most recent year survey, and 55% of producers indicated that they wean for at least 45 days. And we also see that those that wean for over 45 days are garnering the highest calf values year in and year out. The second highest group of responses were those producers who shipped calves right off the cow. The difference in calf values between shipping off the cow and weaning for over 45 days is about $119 a head that weaning for those 45 days get you. Looking down there at the weaned less than 30 days group, focusing more on the calf values, we see that those are actually discounts to shipping off the cow. And then again, jumping over one more group, weaning 30 to 45 days, those calf values are about par with shipping off the cow. There's not that much difference between the two. So the big picture here is that if you're going to wean, you'll want to make sure and wean calves for at least 45 days. We're starting to see more and more programs which require 60 plus days of weaning. If you're weaning shorter than that, you're likely taking more risk from a morbidity and mortality standpoint, and you're not getting necessarily rewarded for that risk that you're taking. Also, with those shorter weaning windows, you're not allowing the calf to necessarily regain weight that is lost early on in the weaning process. Looking at the different marketing avenues, again, the bars are measured against the vertical axis and the values are standalone. We continue to see the auction barn as being one of the most utilized avenues for marketing calves. You'll notice that the values on top of those bars for the auction barn are the lowest compared to the other categories. And this likely has a lot to do with the seasonality in the calf market that Troy just covered here a few minutes ago. Many of the calves that are sold through these auction barns are sold in the spot market in that fall time period, which is typically when we see the lows in the calf market. So I think that's a lot of the reason why the auction barn calf values are the lowest. Going on down the line there, about 10% of producers indicated that they use the direct trade to market their calves. About 20% or a little north of there indicated that they forward contracted cattle. Your video sale cattle would also fall into this category. And then finally, about a quarter of our respondents to the survey said that none of those avenues applied and that they more than likely retained ownership on those calves, either through the stocker process or out on into the feeding, into the cattle feeding processes. Taking a look here at our participation in value-added programs amongst our survey respondents, the vast majority of respondents did indicate that they did not participate in any programs, about 65%. Then you go to the second highest response. The program there is that source and age verification on the far left. It's interesting, though, that those bars have been trending lower here through the past 3 years, especially as source and age verification has become a much larger part of a lot of other value-added programs. Looking at the NHTC cattle, non-hormone treated cattle, dropped about 5% this year from 20 to 15% in the 2022 survey. Those respondents that participated in the verified natural program have been hovering right there around 10%. And then last, we get to the process verified cattle. They've been increasing over the past 3 years, but they're still there, sitting around there, a little less than 10%. At least part of the reason for the increase is the addition of the beef care as a process verified program. So that's important to note there as a possible reason for the increase. Moving on, talking about some vaccination protocols. When it comes to marketing cattle, we all realize that vaccination is another big factor. If you're not vaccinating, you're likely receiving a discount in some way, shape, or form for your calves. This year, we found again that over 60% of producers vaccinate at branding. And as we move to the right there across the chart, continue to see lighter and lighter responses. Around 45% of producers indicated that they vaccinated prior to weaning, another 45% at weaning, 25 to 30% vaccinated calves post-weaning. And then you get out there, less than 5% of respondents stated that they had none applied, and that's certainly encouraging. Another interesting fact to note on this slide is just how consistent the bars of each group are year to year, which is an indication to me that vaccination protocols don't necessarily change over time. They stay pretty consistent amongst each of the respective producers. Staying on that topic of cattle vaccinations, this chart, the bars measure the calf value. So the higher the bar, the higher the calf value. And those bars are grouped by the number of times calves were vaccinated. So we found that 30% of respondents vaccinated one time, and the majority of our respondents to the survey vaccinated twice. We also see there that there's a positive correlation between the number of times vaccinated and calf value, just as those green bars get taller as you work to the right of that chart. Between 0 and 1, there's about a $78 per head difference in calf values between groups that are vaccinated once and groups that are vaccinated twice. There's a $136 a head increase, and that's the biggest jump between groups. Then you get out there, calves that are vaccinated twice versus calves that are vaccinated 3 times. There's about a $40 per head difference. And then finally, between the 3 times vaccinated and 4 times vaccinated group, increase is pretty minimal. By the time you get out there, there's only about $2 a head difference in terms of calf value. To kind of round out our survey results, at least for this evening, we look at kind of that genetic aspect of the equation. The height of the bar corresponds to the calf value, while the color of the bar corresponds to the bull purchase price there. And what we find here is that year after year, there's a positive correlation between bull purchase price and calf value. In each of the last 3 years, the higher priced bulls typically garnered the higher calf values. Focusing on this year specifically, 2022, between the gray and the blue bars, gray being bulls that were purchased for less than $2,500, and blue being bulls that were purchased between $2,500 and basically $5,000. There's a $111 a head difference in terms of calf value. Get to those middle two bars, the blue and the orange bars, orange being bulls that were purchased from $5,000 to $7,500. There's around a $94 head difference in calf values between those bull purchase price categories. And then between the orange and the yellow bars, yellow being bulls that were purchased over $7,500, there's about a $54 a head difference. So we're certainly not saying that all your calf value is derived from a more expensive bull, or that buying a more expensive bull will guarantee to make you more profitable. But what we are saying is that the data supports investing in your genetics will likely pay off. Now, it might take a couple of years to realize these dividends of your investment, but looking at this data, the chances are pretty high that investing in your genetics will pay off over the long haul. And with that kind of, like I said, rounds out our survey results for the evening. Thank you again for sitting into the webinar. I'm going to go ahead and turn it over to our Elanco representative for his comments and presentation, Dr. Faulkner.
Thank you, Holden, and thank you, Troy, as well. I'm always humbled to get to be on the same podium with someone from CattleFax. Have a long personal relationship with CattleFax going back about 25 years, and then the business-to-business partnership relationship between Elanco and CattleFax is very important to us, and we kind of really have a shared vision and purpose around helping people convert all this data and information we have out there into maybe a little knowledge and understanding, and that's kind of where I'm going to try to go today. And I won't be using these slides. I'm just going to talk to you. I kind of pride myself on being a big picture guy, and I'm kind of recognized as one, but when I have to follow CattleFax, I realize I'm in a pretty small picture in the way I view the world compared to the guys that look at it in even bigger and broader ways. But I thought I might use an example and kind of help us interpret and think forward a little bit on how this rapidly changing landscape might impact us and might encourage us to make some good decisions or some bad decisions, and probably bad ones if we really don't think about what we're going through. I've always really believed that we learn by making mistakes and paying tuition, and in this kind of market that can be really expensive, but also that we teach best by using example. So I reviewed some closeouts earlier in the week, and I called today and got some more information to go with them, because I think this example will help understand how some of what we're experiencing right now boils down to us. In general, we're pretty happy, aren't we? We're getting more for cattle than we ever have. We do have some costs and expenses that are up, be it interest or feed cost or fuel cost. But this little group of 450 heifers closing last week that were bought as 4-weight heifers made nearly $100,000 or $200 a head in a stocker operation. So these were a 75-day hold set of cattle. And so anytime you made $100,000 in 75 days, it's been a pretty good 75 days, I guess. And so I think that kind of gives us an incentive that, hey, making money's easy now. Let's relax. Maybe not even spend as much. Maybe reduce some of our risk in this by reducing our cost and inputs. But I go back to something Holden pointed out in one of his earlier slides about the high return producers, how they typically don't change. And I usually would call those high efficiency producers, and that is the producers that produce the most with the resources they have. And I really think that's how we separate the successful and the foreclosed. That's how we benchmark people against each other, or benchmark ourselves against others to say, how well am I doing with the resources entrusted to my care that I'm in control over compared to others that have similar resources. So these heifers, so make $100,000, $200 a head, and they actually lost $25,000 on their risk protection. And these had a fairly complex that I don't even understand where very well spread, which involves some puts and some other things that were moved a few times. But when you're this high up on a ladder, when you're on a 30-foot ladder, you kind of like to have a safety harness and maybe somebody standing by to call 911. If the cattle had been sold cash to cash, they would have made that $25,000 more. If they'd have been sold bought, which means if I'd have contracted them and went short in the market on the day that they were purchased, that would have cost $40,000. So the risk protection, even though it cost something compared to doing nothing, it cost less than selling them the day they were bought. Now, so we're done. We've made the 100,000, or are we? Well, what do you think the heifers cost to replace those? They cost $225 a hundredweight, which is nearly exactly $250 a head more. So in actuality, looking at a checking account today, I've got to have $22,000 more dollars, even though on my closeout to closeouts, I just made money. So this is a very complex market. It's hard to understand. It's hard to do algorithms for it. There's a lot of moving pieces, and you guys are out there making decisions both for the short term and the long term. But I think it would be a mistake to look at high prices for calves if you're a cow-calf producer, or even some good marginal profits, and think that just makes life easy, because it can be pretty tough. Particularly, I think, for the cow-calf producer, because in a stocker operation or a feedlot, I've got some delays in there that are several months long. In a cow-calf operation, a lot of them are for a year. So I could probably sell the highest priced calves I ever will this fall, and I could go buy a pickup and a new washing machine, and take a vacation to Europe or whatever. But the truth is before I get the next set of calves sold, I'm going to have some higher expenses than I've had in years past. And so, be that for feed or fuel or fertilizer or whatever. So we got to really be careful through here. So we're actually the second year into this, and so now I have producers that are kind of making the second mistake, which is, so now we realize that even with these high prices for what we produce, we've kind of got some cash flow problems still. It takes twice as much money to operate. If we're on a line of credit, or if we're working out of our pocket, we can only buy half as many cattle with the same amount of money. Our interest costs have gotten a lot bigger. Our feed is more expensive. Our fuel is more expensive. If you're a long way from where the cattle are going to end up, like we are in my part of the world, which is the Southeast, the basis on our cattle from the increased shipping cost has grown by several dollars, which means that Oklahoma City is a couple of dollars a hundredweight away from us now than it was. And we do have to account for all of those. So, I think that, where I'm sitting right now, that there's a real risk in running the type of production economics that most people do, which is close out to close out, or in using your other financials. You do financials for financial statements, you do financials for taxes, and those miss a lot of the investments we do that come in over the horizon. And it's not only investments that come in over the horizon, but we can also put things on the credit card for over the horizon too, which means we might be looking good right now. It might be money in the account, but if we're not doing those things it takes to maintain performance in our cattle, then in the future we will get a bill on that and have to do it. To wrap up, that maybe having a sense of urgency in thinking through and making sure that I'm planning for the future and doing the right things. I think there's at least 3 conversations that everyone on this call needs to have, and I like to work in threes. And even if you've had these conversations recently, I think you need to be thinking up new questions and have another conversation with the people I'm going to mention here soon, because we're all feeling our way through the changing dynamics of a market. I looked at the Superior catalog for their upcoming sale today, and there was as many dairy beef calves to be sold as there were yearlings or calves or beef calves. I think about 6,000 of each. So there's a lot of moving pieces that's changing, and I think we're all having to assess whether what we believe about what happened in the past is going to apply to the future. So here's the 3 conversations I think you need to have. You do need to have one with your banker and financial advisors and your tax advisors. Like I said, there's different ways we do this accounting, and on this up market, you can end up stuck paying taxes on money that you really didn't make because your replacement costs are higher. Similarly with your banker, whether it's needing additional operating capital or to make margin calls on your risk protection or whatever, you don't want to be bouncing checks when those have to be made. The second one is maybe what I consider the most important relationship, although I can't say that your banker, if you need one, is not just as important. And that is with your key suppliers and customers, and those that you market your animals through. So if you go through a livestock marketing system or order buy of some kind, have those conversations, because what we all really need to do is understand the businesses of our customers better. And when I'm saying customer, I'm not talking about the person that walks in a restaurant. I think we probably understand that way better than we do the next person or two in our chain. What keeps them up at night, and there's something that you can do differently to make their life easier, because I think we're all kind of wanting to move up on the list and into a preferred supplier. And then I also want to be a preferred customer of those that I do business with. I want to get the good deals. I want to get participate in the programs that are out there. And no matter where you are in the industry, I think those conversations and those relationships are worth working on. And lastly, with your production consultants, all of this math has changed. A lot of it is in our favor if we take advantage of it. I'm thinking primarily of our veterinary and nutritional advisors here. But if you're a landowner who produces something green, be it forage or grain or silage, include your agronomists and forage specialists. There's been so much movement in the prices of our inputs and the values of the outputs that what we did in the past is not a good approach going forward when the math has changed so much. And to go with that, at Adelanco, we're blessed to have some of the best performance enhancing return on investment products out there. Most of them that you know well, and we appreciate those of you on the call that are customers, and that's likely most of you. And that's not only products that can protect the health of your herd or help you to market your calves better because they're vaccinated and have a program on them, but those that actually significantly increase your production efficiency, and that's products like Rumensin and Cydecta and Optiflex, the broadest line of implants available. And the thing is, no matter where you are in this industry, you can stack 3 or 4 of those technologies I just mentioned, and each of them will increase your production efficiency 10%. So it's not unusual for me to walk into an operation and someone be complaining about the other idiots that are paying too much for cattle, or a neighbor that just paid more for a place that they really wanted to buy that was maybe between them than they were willing to or able to pay because their calculator just wouldn't make it work. And I think oftentimes the idiot might not be the one making the statement, because often they are not using these disruptive technologies that increase your efficiency. And I just did some quick math that I thought would apply to whether you're stocker, feedlot, or cow-calf. Using Rumensin, increasing your feed efficiency on $200 worth of feed by 5-10%, an implant giving you 20 more pounds, better control of external and internal parasites could be another 20 pounds. That's 40 pounds total, worth $80, let's say, and then $20 on the Rumensin and feed efficiency. So now we're talking about $100 a head. So if I'm a stocker operator sitting there bidding on cattle against you, and I'm using these technologies, and I've got $100 a head more than you, that means once your calculator has put you in the red, I'm still in the black for $100 more or $20 a hundredweight of purchasing power against you. And it's the same in your operation. If your long-term goal is to grow your operation where it can accommodate family members for future generations, making your operation the most efficient is the difference between you buying the neighbor's place and being the neighbor's place. Because even though it's not going to matter this year, being able to bank some of that money and to be able to go in with a business plan to a banker when a place becomes available and say, here's how it's going to work. You can't do that without taking advantage of technologies that others do. So with that, CattleFax, I appreciate you. I appreciate those on the call. We at Landco and myself personally are committed to measuring our success for your success. We've got not only good products, but good people, good partners like CattleFax, and what we need to know from you is what we can do to help you accomplish whatever goals you have for your operation. So with that, Troy and Holden, I'll turn it back over to you.
Thank you, Dr. Faulkner. I really appreciate your time today. Everyone who joined us on this webinar, we appreciate you joining us tonight, and everyone have an enjoyable evening and a great Memorial Day weekend. Thank you, everyone. Bye.
Thank you.